We want to bring in Brian Belski. He's BMO Capital Markets Chief Investment Strategist. Brian, it's great to have you back here. It's good to see you, of course, coming on a day when I know you're still bullish. You have a year-end S&P price target of 4,800. Here we are today in bear market territory, just above 3,700. Help us make sense of the action that we've seen and why you're still bullish at this point.
Well, Shauna, great to see you. It's always wonderful to be on Yahoo. I have no idea why you're talking to me because I'm wrong. But listen, with much humility, we've been wrong, but I don't think we're wrong on the overall trend, Shauna. I think we're just probably wrong on the timing. And we're not market timers, we're investors. And we have a long-term process that says we still think that U.S. equities are the best asset in the world. I just think that there's been such a confluence of events with respect to what we're trying to deal with whether or not we're still trying to measure if inflation is an exogenous event or if it's going to linger. The market is acting like it's going to linger a little bit longer. And then we had the Fed indecision. And remember, a couple of years ago, the Fed came in to save the day and no one was complaining. And now, obviously, we're complaining because the Fed has clearly kind of misjudged this in terms of how long inflation is going to linger. So I just think that at the end of the day, this really goes back to bonds. And we've had a 40-year bull market in bonds that nobody seems to want to talk about in terms of the unwinding of the bond market. And nobody really wants to admit that that the effect of that actually could be positive on equity. So again, at the end of the day, we think that inflation, there's a very good chance that inflation is going to roll off faster than everybody thinks. Everybody is already positioned for a long, drawn-out affair with inflation. The rate of change, according to the PPI, was already starting to change. We had a bad CPI print, obviously. But as was said in the beginning of this hit, you have consumer sentiment down. The market's it's officially entered bear market territory in terms of the academic books. The market was already trading like we were in a bear market. Now we got to kind of find a re-rate on what we're going to pay for earnings, what kind of assets we're going to be in. And we know, that the majority of investors that we talk to around the world are not positioned, Shauna, I repeat, not positioned for upside. They're positioned for downside. So if we get any kind of surprise, we're going to have a squeeze upon squeeze. And I really think the market's going to surprise people to the upside the second half of the year.
Brian, what are you seeing that tells you inflation will soon go down? There are some that feel we may go to 9%. And what would surprise the markets tomorrow?
Well, I think it's already baked into the market, Dave, that we're going to see 75 basis points. The Fed kind of did a good job, I think, kind of whispering that to more than one outlet. So it's probably going to see 75 basis points. I think this all comes down to over the next few months that we start to see a potential surprise in either CPI or PPI, a sub 7% number, I think would really surprise people. There is already evidence, though. We saw, again, the rate of change begin to slow on a month-over-month basis in PPI yesterday, number one. Number two, we have some barges coming into the ports that at the ports now, we have people that can actually unload the barges, which is much different from a supply chain level. Obviously, the big side of things is going to be the commodity of oil. At some point, we're going to have a break in the oil price. And so I think we're already convinced that we're going to be in this high inflation environment forever. And I just don't think that's going to be the case.
And since you are still bullish for now, what are some of the key indicators that you're keeping an eye on, which are helping you really gauge how to position your portfolio and when to rotate it?
It's a great question, Rochelle. I would say that earnings are going to be the key. And we still feel very confident that earnings are going to be a lot stronger than most people think. The revision side of things have already hit current year revisions, but not really next year revisions. And numbers, even for what we saw in the latest quarterly numbers, were better than expected again. And if you take a look at the operating performance of companies, meaning return on assets, return on equity, balance sheets, cash flow, it's still very, very strong. So I think we've kind of entered in really for the better part of a decade that's under promise and over deliver, where companies have been actually more conservative in their outlooks. So I think earnings are going to be the key. From an indicator perspective too, we need to see the employment situation in terms of participation rate increase. But I do think that the Fed is kind of, they're trying to lace this perfectly, like thread the needle. And I think it's going to be increasingly difficult. So that's why tomorrow's messaging, because people care more about the messaging actually than the actual event. So we could be heading into a situation where you sell the rumor and potentially buy the news once we, as the investor base, feel better about what's going to happen going forward based on the Fed's comments following the news tomorrow.
So, Brian, if we do see a pop tomorrow, if we do see the markets regain some of that momentum that we saw back in 2020 and in 2021, you said that investors aren't positioned for the upside. So that leads me to ask you, how should they then be positioned in order to capitalize on those gains?
Well, we really think you should become less cyclical and more kind of value and GARP oriented, meaning growth at a reasonable price. You know, the market's done a wonderful job discriminating against those areas that were either too frothy, too expensive, or had no business trading where they were. So I think you want to go back in and look at those names that are offering growth at a reasonable price with more of a value bent. Many of these names are in financials, healthcare, even some parts of technology. There are some of these stocks were mentioned prior to my speaking, but also communication services. I think on the growth side, the Netflixes and Googles of the world, I think are a wonderful complement to the more yield side, meaning Verizon and AT&T. So you have a classic barbell within communication services.
So you talked about, this is just one of those moments, Brian, where they haven't been paying attention. Now, our audience, yes, but the mainstream audience is opening up the New York Times. It's above the fold. They're opening up the Drudge Report, and it's the first thing glaring at them if they are set to retire in the next couple of years versus those that are in it for 10 or 20 or the long term. What's your advice to them at this moment?
I would say speak to your relationship manager and talk about equity income, Dave. I think equity income growth, dividend growth has been one of our primary themes for 10 years, maybe 15 as a strategist. And dividend growth and value portfolios are actually outperforming the market this year. But I still think that there's a great opportunity to find an income stream of 3 to 4%. There's several equity dividends. We happen to run one here at BMO that are throwing out 3+% income. So I think that can take place of some of investors that are still, frankly, still overweight bonds, Dave. And I think that's where the real risk is. And again, we talk about how crazy the stock market is, but the bond market, there needs to be some accountability from the bond market because that's where all the momentum has been for the last 40 years. So this unwind is going to be, I think, actually be a plus for equities, but you have to be positioned accordingly.
And I do want to ask you, obviously, the last three bear markets that we had, 2000, 2007, 2020, how should investors view this current phase we're in versus those phases?
Well, the bear market of 2020 was your black swan, Rochelle. I mean, in the 2007, 2008 was the 3C bear market where you had a consumer capex and a credit. We had a credit recession, but really in 2000 was led by technology. We flooded the system with too much capacity. So three different types of bear markets. Obviously, you have a 34-day, 34% bear market in 2020. Again, exogenous event of the black swan called the pandemic. So every bear market is different. You can't go back and look at the academic books and try to play the same scorecard. I think many people are doing that, and I think it's a big mistake. And so I do think that's why you have to kind of employ more of a growth at a reasonable price value discipline, where you're looking at companies that have great management, great product, great service, discernible earnings at a reasonable price.
Brian Belski, always great to have you. Thanks so much for hopping on and joining us. BMO Capital Markets Chief Investment Strategist.